folks. Thank you very much for joining us today. My name is Patrick Ray. I'm one of the AT&T focused retirement advisors with the Retirement Group, and we certainly appreciate your attention. If you've been to our webinars before and you're looking forward to our material today, welcome back. We appreciate you joining us again. And for those of you who have not joined us before, welcome. We hope that you find value in what we have to talk about today. And today I've got specifically some discussion to talk about one of the questions we get about what extras folks can do in an effort to try to meet their overall retirement goals and objectives in case they feel like they're falling short or in case they're trying to maximize the efficiency of their retirement at the end, and certainly look at creating what is referred to as a tax efficient retirement. And so we're going to talk about that today. But before we get started, the Retirement Group, if you haven't heard from us or about us before, has been in business for over 30 years. And we have a ton of knowledge and experience in dealing with folks who are on AT&T's payroll and helping them transition into a successful retirement. And I personally have met with over 10,000 AT&T employees since 2002. And we take a lot of pride in bringing the value to help you make one of the most important financial decisions that you'll ever have to make when you lead into retirement. And one of the avenues of material that we use in an effort to bring this material and information to you is this webinar platform. So throughout the presentation, you're going to find links in the chat to give you access to some of the recordings that we've done in the past. So feel free to peruse those at your own leisure. And you'll also find a link into the chat to get access to our ebooks library, which has a bunch of short to read topics that we get asked on common questions on a very regular basis. So those are enlightening for sure. And I encourage you to read those when you get a chance, as well as maybe the most important thing that we could provide you, which is a detailed analysis of your financial situation to see if you're on track to meet your overall goals. We refer to this as a cash flow analysis, or something we refer to specifically as a retire kit. And if you're willing to spend some time with us, we're delighted to produce this document to you at no charge or obligation to you. So I'll give you a way to get in touch with us at the end of the workshop this afternoon in an effort to reach out to us if you're open to that. And if you're not already doing so, I encourage you to follow us on our LinkedIn page, because we give a lot of up-to-date and accurate information related to the interest rate environment and what's going on at AT&T and things that you'll find of value for sure. But before I get into material, lastly, I would like to remind everyone that we are not affiliated in any way with AT&T, nor are we affiliated with Fidelity. And as it turns out, our experience just simply comes from the thousands of people that we have met with over the years in an effort to help them who are in positions similar to yours and trying to get them to transition into a successful retirement. So our material today has to talk about a specific topic related to Roth conversions, and something that is unknown to many with respect to how you can take advantage of a number of things to get to building a pool of money that will potentially grow tax-free for the rest of your lives. And so there are a couple of ways to do this, and we'll talk a little bit about the first way, which is a strategy to allow you to bypass contribution limits, because many of us on the call with combined household income make too much money to actually contribute to a Roth IRA. And so something to consider is making a contribution to a non-deductible IRA and then simply converting that into a Roth IRA. And the first feedback and hesitancy I get from many people who, when I talk to them about this, is it's only $6,000, or it's only $6,500, or if it's only $7,500 if you're over 50 or whatever. And it doesn't seem like a lot of money. But the reality is that if you were to do that for both you and if you're married a spouse, and you do that for consistently a 5 to 10 year window of time, it's conceivable that you'll have a nice chunk of money set up in a Roth IRA that's growing tax-free for one and or both of you as a spouse if you're married. So in our opinion, obviously the majority of funds that we are responsible to manage and talk to people about have to do with their pre-tax funds, because it mostly comes from the pension funds and or their 401k monies. And typically those monies have never been and circulated through the tax system before. But one of the things to consider is what I'm referring to. And even though it seems like a very small amount, it can build up over time, which is one of our goals. And we're trying to make a number of things happen with getting as much as we can filtered into a tax-free growth scenario. And this is just one of a couple of ways to do that. And so this is kind of what it looks like. You take your current income, you make a non-deductible contribution to an IRA, which you're allowed to do regardless of what your income level is. and then ultimately just simply convert that to a Roth IRA. And so there won't be any beneficial tax treatment related to doing that on your tax return in the year that you make this actual transaction. But in fact, it allows you to start earmarking money to get filtered into the Roth IRA system. So it's a pretty unique opportunity for you to take advantage of what is a addition to many of what you're already doing, which is adding monies to your 401ks and potentially managing inheritance and outside funds that you have if you have extra money to try to build as much money as you can in an effort to have a comfortable and successful retirement. Another strategy might be to consider what's happening inside your 401k. And specifically, AT&T allows you to overfund your 401k, which is one of the requirements that would be necessary in an effort to allow yourself to be able to take advantage of this. But some people don't know that you can actually put in a substantial amount of money over and above what the IRS allows you to put in to your 401k before taxes. And so when you have a consideration of what you're doing to contribute monies into your 401k, if you include the AT&T match that's going on your contributions, basically what you're going to find is many people think of the ceiling of what the IRS allows you to do, which is somewhere in the neighborhood of $26,000, depending on if you're over the age of 50 or not. And the catch with that is that that's a technically true statement, but you can save far and beyond over that number inside your 401k if you choose to do so. And one of the couple of reasons that you may want to consider doing this is simply to allow you to take advantage of a unbelievable gift that the IRS is effectively giving us, which is allowing you to take any after-tax contributions that you have made inside your 401k and move those directly to a Roth IRA. Let me say that again. So if you have after-tax money inside your 401k, you are able to remove that money and move it directly into a Roth IRA so that immediately when it hits your Roth IRA, it will grow tax-free for the rest of your life. So there are, of course, a number of reasons why you would want to consider doing this. But on this slide, we talk about the addition of the $22,500 that you can put in before taxes. Because of the threshold, you can put in up to $66,000. It allows you to put in an additional $43,500 inside your plan. And again, one of the main reasons you would want to consider doing anywhere close to this, or if certainly you can afford to the absolute max, is because it allows you to earmark that money to go into a Roth IRA without any contribution limits, without any qualifications that are making you currently ineligible to participate in a Roth because you might be making too much money as a household. And so if you consider what you're putting in plus what the match is on the 401k side for AT&T, you're, of course, in most cases concerned about trying to reduce your income tax in the liabilities the year you make the money to put into your 401k. So this is beneficial for sure. But so is the back end of this discussion where it allows you to put money into the after-tax portion of your 401k, which ultimately you can earmark to go into your Roth IRA. So basically an eligible requirement would be your employer, in this case AT&T, needs to be able to allow you to do so. So the plan inside Fidelity allows you to do this, and so that's a check mark or a benefit to you. They also need to allow you to make in-service withdrawals, and this is also a benefit to you, which means that while you're still employed and while you're still working, you can earmark this money of what they call an in-service withdrawal or a general withdrawal. If you don't know how to find this on the Fidelity website, just reach out to us. We're delighted to walk you through the process so you can see what this amount is. And you can move that directly to or outside the plan while you're still employed. And if you have, as I've been speaking, the after-tax portion of this money inside your 401k, you can move that money directly to a Roth IRA. So the sooner you do that, the more advantageous it's literally going to be for you, because remember, the after-tax portion of monies that's inside your 401k is growing on a taxable basis. So in other words, if you put in this $43,500 and maxed out the after-tax contribution and it grew to 50, what's going to happen is you'll have $43,500 of after-tax money you can move to a Roth IRA, but the extra $6,500 that it had grown to would have to go into an IRA. And that way you would not be responsible to pay tax or penalties on those funds until ultimately you distributed those out to your household as income. So this allows us to maximize our 401k for sure on the after-tax side. Of course, This does not mean dealing with the Roth 401k. And so just so we're clear, there's also an option inside your 401k that allows you to earmark money to go into the Roth 401k. And the difference between that is that that's already utilizing the qualification of what you can put in on the pre-tax side, except you're not getting any in-service year deduction to make that contribution. So in other words, if you put money in your 401k before tax and you make $100,000 and you put 10% of your income into the 401k pre-tax, you're going to earmark $10,000 to go into the 401k. And even though you earned $100,000, you're only going to pay income tax on 90 in that given year. Whereas if you earmark money to go into the Roth 401k, which you absolutely could do, you're going to earn $100,000, pay income tax on the money that you earn based on your withholdings, and then put that 10% going into the Roth 401k, which then ultimately grows tax-free. So there are different scenarios for sure. And what we're speaking of today is the after-tax portion where you've met the before tax limits of $22,500 and getting the additional monies into the Roth the after-tax money, which ultimately will land into the Roth IRA. So we want to make sure that this is, I know this is a little confusing as a topic, but the material is unbelievably valuable to you because this is one of the gifts that the IRS is still allowing us to utilize as advice to our clients and prospects. And so we encourage you for sure to take advantage of that. So this is kind of what it looks like. If you take your 401k contributions and your pre-tax match from AT&T and then ultimately put in the max, well, 41,500 in this case. So what it looks like is we've got 41,500 of after-tax monies growing in your 401k. So the sooner we get this $41,500 out and moved to a Roth IRA, the sooner this pool of 41,500 grows tax-free. Because remember, the after-tax portion of your 401k is already been taxed, except for whatever it earns is going to be considered pre-tax money. So remember, the 41,500 is going to be a stagnant pool of funds because you've contributed after-tax funds, but the earnings on that would be 401k monies or pre-tax monies, which means that you're going to be responsible to pay income tax when you take that money out. So this is kind of what the strategy on the Roth conversion and the graph kind of looks like in the big picture of things. So let's talk a little bit about the taxation of these withdrawals. So for your 401ks and your IRAs and your other tax deferred accounts, remember, you are beyond 59 and a half. There's no penalties or any problems with removing money from your IRAs, but you'll basically just pay income tax on the federal side, and depending on what state that you reside in will dictate if you do or don't pay state tax on those distributions. But if you choose to move money before you're 59 and a half, I would encourage you to check out our 72T and our post 55 separation videos that you can find on the links in the chat to give you some understanding of the rules that are available in case you're before 59 and a half and actually need to create income or withdraw money from your retirement accounts. But we'll assume for this discussion that you're beyond 59 and a half, you're penalty free, you can remove as much money as you want from your IRAs, but basically you're going to pay income tax on the funds. Now, some of you can afford to defer taking any money out of this IRA until the minimum mandatory distributions come around, which are referred to as RMDs. And they just changed this rule, so now this age is actually 73. And by 2033, this age is going to be 75, unless they change the rules again. So what we're talking about here is the ability to defer all the way out to 73 years old if you choose to do so, before you're forced to start pulling money out of your IRAs, even if you don't need the money to spend or live on, to ultimately filter that money through the tax system. Because remember, that pool of money or pool of capital has never been taxed before. And so, of course, the IRS wants to get their hot little hands on some of that for your privilege of being able to defer it for however many years until you get to 73 years old. But ultimately, it is a taxable event to you. And so this is part of our discussion that we have with our folks about the proper tax planning, and certainly from a tax efficient retirement portfolio and income perspective, that you may not want to wait until you're 73 years old to start removing money from your IRAs in an effort to take advantage of certain tax situations and so forth. So we're delighted, obviously, to talk to you more about that if you're open or interested or have more questions about that specific topic. But on the Roth side, you have money that's growing penalty and tax-free after 5 years, and as long as you check the 59 and a half box. And so the principle of what you put in plus any growth, obviously, after the 5-year window of time, it's growing completely tax-free. And maybe the best part about this particular pool of money in the Roth is that it's not mandatory to take any money out. And then assuming that you don't spend any money, you're doing your kids and beneficiaries a favor by having the money already been filtered through the tax system. So there's a lot of advantage to this specific planning. And when we get to our folks who we talk about, they're putting in what they can afford to put in their 401ks, and they're trying their best to meet their overall goals and objectives ultimately for retirement purposes. But then they get to a point where they can do a little extra, or they want to consider doing a little extra. This is kind of the discussion that we certainly want to have with them to consider additional avenues and additional benefits of doing some planning to try to meet their overall goals and objectives. So the Roth conversion strategy is ultimately a wonderful tool for us to utilize. And so this is kind of what the example looks like if we converted $50,000. So if we've got a 50-year-old who's at the current tax rate of 24%, we're going to assume that that tax rate stays the same when they retire, and that they're 50, they're converting $50,000, and retirement is 65 for them. We're going to assume that they have a 5% rate of return, which some people would argue is low in retirement. And you've got a Roth tax liability because we owe income tax on the year that you make the conversion at $12,000. And so these three columns are just representative of the different tax rates that you might find yourself in during retirement. And then ultimately what the Roth balance looks like, because regardless of what tax bracket you're in, that pool of money is going to be the same. And then, of course, deteriorates over time if you're in an IRA, because the more tax you pay, the less money you ultimately have. And then we further assume in this last column that you've got the IRA, plus we invested this $12,000 tax liability over time, which gives you the most money in the least tax bracket, but ultimately continues to go down similar to this column in the IRA in an effort to meet your overall objectives. And so Roth conversions are beneficial if you believe tax rates will be either similar or higher in the future, and it gets you the ability to take advantage of low tax rates. And then we would talk to you further about making a tax efficient retirement if this is part of your income strategy for sure, to talk further about what benefits you might get from that. And the issue is that it takes some planning. And unfortunately, we know that 74% of the people over the age of 50 do not have a written financial plan. And frankly, this is unacceptable simply because we offer this service as a benefit to you for no charge. And there's no obligation to do it. It's a way for us to introduce our services to you. And if you're looking for a partner in retirement, certainly you may want to give this some consideration. But even if you're not, and you've got your ducks in a row and you're planning on tackling retirement on your own, it's still a good second opinion type scenario where you would get a qualified opinion, if you will, or some feedback on what your current situation looks like and if you're on track to meet your overall goals and objectives. So if you'd like to schedule a meeting with us, you can do so by emailing us at info@theretirementgroup.com. You can also phone us or give us a phone call at the 800 number, which is 800-900-5867. You can schedule some time. If you have a mobile device, you can take a picture of this QR code to the left, and it gives you access to our calendar where you can pick a time that works, that's convenient for you. And then, as I mentioned at the beginning, if you're not already following us on LinkedIn, I encourage you to do so, because we have a lot of feedback with our AT&T folks and current rate updates and stuff like that are great to have access to. So take your mobile devices and do that. So what I'm going to do is I'm going to answer a few questions, and then I will let you go for the afternoon. So let's see. Question number one, is now a good time to do a Roth conversion if my portfolio is down? Well, I would qualify this and say, I guess it depends. I need to know more about this particular circumstance. But in general, it's a fine time to do a Roth conversion when you consider you're able to do a Roth conversion and move shares in kind, as an example. So if you had 100 shares of a given stock that was down by 20%, now would be a fantastic time if all the check marks arise and you're able to do so, and you think this is a good idea, that you can move that money into a Roth IRA in hopes that the appreciation of that gets back to where you paid for it or more, and you absorb that additional growth on a tax-free basis. So it absolutely makes sense to consider a Roth IRA or a Roth conversion if your portfolio is down, for sure. Question number two. With a Roth conversion, you say I need to pay taxes now. Where's the break-even point? Well, that's a good question. That's certainly a time value of money calculation, so it would be different for everybody given the tax rates and time horizons and age and amounts and those kind of things. But certainly there is a break-even point. This is a discussion that we have similar to what we talk about when our Social Security topic comes up with our clients. But there is a break-even point, and certainly it may give you some benefit to do that now, and at least to do some homework, if nothing else, because you do have to have the tax monies available to pay in the event that you do consider the conversion strategy, right? So in other words, it's going to be a taxable event when you have in the year that you make the conversion. So you want to make sure that you have the ability to pay the tax liability or withhold it from the conversion amount so that you send the estimated payments into the IRS so you don't have a big tax bill to deal with. But certainly there's a break-even point, and for all the reasons that we talked about, it makes a ton of sense to at least consider it for sure, and we're delighted to walk you through that process in the event that you're open to that. And then lastly, can you do an analysis and calculate if a Roth conversion makes sense? Of course, absolutely. I mean, this is part of the cash flow process, and we can put all kinds of aspects and different scenarios in on what may or may not make some sense for you if you're trying to do some homework and planning, which we encourage everyone to do, of course. And the sooner you do that, the better off you're going to be in reality. So as I showed you in the slide, most people over the age of 50 don't have a written financial plan, and there's just no need for it because we're delighted to spend some time with you and walk you through these scenarios as the question came up, and help you decide if it does or doesn't make any sense. And we can do all kinds of different views and give you some feedback on what that looks like. And so all you have to do is reach out to us. You can call us at 800-900-5867, or you can email us at info@theretirementgroup.com, and we're delighted to get back to you. So with that, what I'm going to let you do is go for the afternoon. Thank you very much for spending some time with me today, and I hope you found some value in what we had to talk about. And certainly, if you have further questions, we'll look forward to chatting with you. So until next time, everyone stay safe, okay? Have a great day.